Alcon swung to a fourth quarter net loss of $97 million, but revenues topped expectations. The eye care company issued better than expected guidance, expecting sales growth of up to 8% in 2023. Well, speaking to Juliana, Alcon CEO David Endicott said price pressures pose a major problem.
Inflation is a big part of our challenge in gross margin last year and continued to be, I think, going forward. We've seen costs in resin, costs in freight, wage costs all over, all of them accelerate. And obviously, we've tried to do what we can, both in terms of productivity gain. Of course, we work a lot on throughputs, on efficiencies in the plants. But also, we've had to go to price. We've taken some price increases, particularly in our contact lenses, which we're always thoughtful about. But at the same time, we've tried to put those two pieces together, really, right? A little bit on the cost side, as much as we can on the productivity side. That's really how we're trying to manage the impact right now.
And when it comes to your outlook for 2023, you are looking at mid to high single-digit sales growth and continued margin expansion, as well as high teens earnings growth. Can you give us any more color on margins and how you expect them to progress this year?
Yes, I mean, margins are, for us, have been a big deal. We're obviously trying, we had a thesis when we spun out, which was really get our R&D flowing, get product flow moving again, like a world-class eye care company could, and then see that revenue expand at a much greater rate than our cost structure. So we've done a number of things, really all around operating leverage. So, we get a little bit from gross margin. Maybe over our planning cycle, there'll be 20% of our core operating improvement will come from gross margin, but really isn't the main thing. The main thing for us is, getting revenue growing at, mid-single digits and holding our costs, significantly growth significantly below that. If we do that right, we're going to see kind of this, mid-teens earnings growth, and that's really what we're trying to drive at.
Well, Endicott also told CNBC he's planning for a mild recession.
We've talked about resilience in our markets, and directionally that's correct, and in relative terms to a lot of consumer products, that's true. We did, as we put out guidance today, what we did say was we expect kind of normal growth rate minus a little bit. So we are planning for a mild recession. I think that's prudent from where we sit today. I hope that doesn't happen, but given the irregularities and the kind of dynamics that we see today, we felt like that was the right place to go. So we said, look, we should see normalized market growth, less about a percentage point. That gives us a pretty decent market expectation, and then I think we'll exceed that market growth with our own performance. So, we guided again in the 6 to 8% on the top line.